McElroy and Ben Mala are doing, then I think we need to step back and ask ourselves, if those two legends are doing it, what does it mean for me? I know that is something that I sit here and ask myself all the time. I assume it is something that you ask yourself as well. So before we get into what Ken McElroy and Ben Mala are doing, I do want to say thank you, thank you, thank you. Yesterday, I highlighted that I was lucky enough to be interviewed on the Iced Coffee Hour. I asked the audience to go over there, watch it, like, comment, and you guys blew me away. I read every single comment as of 6:30 a.m. this morning. I tried to reply to each and every comment. Thank you very much. Again, it was an honor to be on that show. It does, I mean, when you look at the legends that have been interviewed on the Iced Coffee Hour, it is a humbling experience. And I want to thank again Graham and Jack for giving me the opportunity to hopefully grow the middle class. That's what that interview was all about, was breaking it down, trying to help people believe it's possible. So I appreciate all of you going over and watching it, leaving a comment, a like. Hopefully we can get that to 100,000 views. I appreciate all of you taking some time yesterday. So let's get into let's talk about Ken McElroy first. So Ken McElroy, over the last 6 months or so, has been doing a wonderful job of highlighting how he is treating this market. If you rewind in time, he used an analogy that I think he is executing beautifully right now. He talked about these large super tankers who are trying to change and move about in a world where rates went up, cap rates went up, NOI went down, and they're struggling. Ken McElroy had been on the sidelines for quite a while, which frankly I respect. I respect the fact that he stayed true to his buying criteria. He didn't chase bridge debt, IO, anything that was painful. Again, true legend. But he highlighted that he is about to become a speedboat. What does that mean? Well, it means to me that he's going to be opportunistic. He is going to find perhaps construction projects that are yet completed. Perhaps he will find projects that are yet filled. And he is already buying. Yes, folks, Ken McElroy is already buying. Apparently, he just closed on one transaction and has another that is in escrow. He put out a video yesterday that said that he thought cap rates went from 4 to 5.5. And if you don't know what that means, that essentially means they have seen a roughly 30% haircut in price. This was something Jonathan Twomley and I tried to highlight for you well over a year ago when we turned a $100 million property into $48 million. It is very easy to do when cap rates get compressed. Then the question came about, where are we in this pain cycle? Ken McElroy used a frequent baseball analogy. If you don't know, baseball typically is 9 innings. And Ken McElroy went on to say, we are in the 3rd inning. So again, 3rd inning means, I don't know, call it 33% through the game. But yet he is already buying. I think you and I need to step back and realize what Ken is buying and why deals are not there for folks, at least like me and probably like you. So the first thing you have to realize about Ken McElroy is he's buying Class A, maybe even Class A+. And if you've heard me talk to Anna Kelly or Jonathan Twomley over the last 6 months, that is the only part of the market that is trading. We have yet to see price discovery in Class B and Class C. So when I hear Ken McElroy is already buying, I get excited. But then I have to temper that excitement with the fact that Ken has tens, if not hundreds of millions of dollars to deploy. He has a complete top-notch operation, and he is looking to take advantage of deals in Class A. When you step back and look at Class B and Class C, which is where I play, and a lot of you, That stuff is not retrading. We have not had price discovery. The other thing you must realize is if Class A cap rate went from 4 to 5.5, it is very likely, if not certain, that cap rates in Class B and Class C will go higher. Folks, if you don't know, the reason that I got so concerned years ago about the commercial market, 21 and 22, was I was seeing Class C and Class B properties trade like Class A. I've been doing this for 25 years. That is not supposed to happen. That is not supposed to happen. So it would not shock me if Class B and Class C cap rates went higher. The question, of course, is how much higher? Could we go from, say, 4.5 to 6.5? I think that is rather certain. Could we go from 4.5 to 7? I think that is certain. Class C, again, Class C was trading at very compressed levels, at least in my market, down to a cap rate of 5, maybe 5.2. And again, Class A was like 3.8 at the most craziness. It would not shock me if we saw Class C go much, much higher. So again, it's encouraging that Ken McElroy is buying. It's a sign that there's a start to a cleansing process. But in my opinion, it is only the Class A market that is in inning 3. I think Class B and Class C, frankly, are still warming up. They are still warming up. The game has not even started. That, of course, is my opinion. When in doubt with multifamily, listen to Ken McElroy. He is far more experienced than me. But again, as someone who's looking every day, I have yet to find a Class B or Class C with any kind of cap rate expansion. Lots of wish pricing, hopes, and prayers. All right, now let's talk about Ben Mala. Ben Mala is on a selling spree. The Iced Coffee Hour really highlighted that Ben Mala is trying to sell all of his commercial properties. He is looking to exit. He is looking to get more liquid. If you don't know, Ben Mala has been very clear. He failed to lock in low rates, and his interest rates have, in many cases, according to him, tripled. And in many cases, he is losing money on properties. Ben Mala says a major correction is coming to the market. Again, you have to realize that Ben Mala is talking commercial. He is far more strip centers and hotels. But again, Ben Mala is a legend. Major correction is coming. People are doing stupid things. These are quotes from Ben Mala's interview. There are tons of loans being sold on the market right now at significant discounts. So it appears that Ben Mala is trying to take his portfolio and get small so that he can raise capital, so that he could take advantage of what he sees coming. It is going to be very interesting. He has made this decision to sell at the end of 2024. When I think, as you know, we've been highlighted by Ken, the pain is already being recognized. His assets are leased, at least it appears in many cases. So it is possible there's 1031 money, possibly some hedge funds looking for particular assets. But we have to wish Ben Mala luck. It does seem that maybe, just maybe, if he could rewind the clock, he should have sold last year. But again, I don't have a time machine, no DeLoreans here. So again, we will see what happens. So again, very interesting to watch two legends really react differently. Ken has started buying, again, multifamily. Ben is selling strip malls and hotels. Again, different assets, all three commercial. I want to talk about two videos that went out yesterday. Yesterday, we had a video with Brandon talking about BRRRR 2.0. As you know, if you follow my channel, I even wrote in my book, 15 Conversations with Real Estate Millionaires. BRRRR is an advanced strategy. It is frankly a strategy that worked beautifully for 5 to 6 years. It does not work today in most markets. But I want to give Brandon a shout out. He has found quite possibly a BRRRR 2.0, What is different? It is frankly the B, right? Burr. He is building. One of the things Brandon has realized is he could build new construction in his market for about 20% less than the after build value. That allows him to buy lots for 10 to 15 grand, get a construction loan, run through the build cycle, and then refi out or get permanent debt and get most of his capital back. Again, this video is live on my channel. At the end of the video, we go through 2 yield calculations. Now, from memory, the yield calculation of one of his deals, I think he left like $6,500 in the deal. And I think he was cash flowing $3,600, something like that. You can watch the video. That yield is 55%. A 55% yield. Brandon went on to say that he wants to even add more cash flow. If you're adding more cash flow, it means you leave more money in the deal. The second example we went through, his cash flow went up to $6 grand or $500 a month, which meant he left, I think we said about $30,000 in the deal, or maybe $32,000, something like that. And at the end of the day, his yield went all the way down to a whopping 17%. Again, as you see in that video, there is a lot of process and procedure. It is not for everyone. But it is pretty interesting to hear someone take Burr, twist it, and find another way to make it work. So shout out Brandon. Second, we had a conversation with Kimberly about a 12-unit seller financing opportunity. Unfortunately, our Wi-Fi connections were not great and the sound quality was horrible. Just this morning, I went in and turned that video to unlisted because I didn't want anybody to suffer with the audio. But I want to give you the crux right here of the offers that I told her to do. So to set the stage, 12-unit building, seller thinks it's worth 2.7. Kimberly and her husband think it's worth $2 million. So a $700,000 delta. It does appear that the seller is open to seller financing. As with most sellers, they not only want their price, but they also want 8% money, which if you're not paying attention, is above bank rates today. So why would anybody do that? So during this conversation with Kimberly, I outlined 6 offers. I wanted her to put together 6 offers. I wanted her to do the math. I wanted her to work with her agent, to go talk to the seller and see what makes sense. Let's talk about the first 3. The first 3 assumes the seller will finance the entire property. We assume in this example 80%. So Kimberly and her husband will be putting down 20%. What I needed Kimberly to do is do the math. I wanted her to do the math on 2.7, right? What the seller wants for price and what she could afford on a payment. Now, I have no question that there's no chance in heck that she could afford an 8% mortgage because, again, she should know her numbers and run the calculations and expenses and all of that. But it is very likely that if she got a 2, maybe 2.5% 30-year loan, it would cash flow. So I wanted Kimberly to do the math and say, hey, Mr. and Mrs. Seller, I can give you 2.7, but here's the payment. Because one of the things that Kimberly and her husband should do in that first conversation with the seller is say, hey, we are cash flow investors. We will hold this asset for 30 years or forever. So we have to make sure it cash flows. I can't pay you 2.7 and 8% because that would be an alligator or negative cash flow, and I would lose the building. You don't want me to lose the building, right? Of course not. So there's the setup. She does the math on 2.7. Second, she should do a second offer at $2 million. And then again, the interest rate would be higher. Again, the interest rate would be higher. And then, of course, I wanted her to do something in the middle. Maybe at 2.4, at 2.5, just to show the seller, if you are willing to carry, we can do all the math, but that payment has to be no larger than X, whatever X is in Kimberly's opinion. So those are the first 3 offers. The other three offers, I said, Kimberly, maybe this seller wants more than 20% of the cash. So what I want you to do is I want you to leverage the 50-40-10 from Velocity Mortgage. I wanted you to potentially give the seller 60% of the cash, 50% from Velocity, 10% down, and the seller only takes back 40%. In our first example, she was carrying back 80%. In this example, she's only carrying 40. So again, it's a very simple math formula. I wanted her to do the math at 2.7, 50, 40, 10. I wanted her to do the math at 2 million, 50, 40, 10, and then pick some number in the middle. Now, by having this 6 offers and sitting across from the seller with her agent and having that conversation about cash flow and hold period, and of course, actual rents, she could lay it on the line. Now, it is possible the seller wants none of this and she's stuck on her price and her interest rate. Okay. But by doing this, you're practicing. This doesn't always work. But if you do this, you write the 6 offers, you understand the story, you understand the difference between all 6. It is something that will benefit all of you and get you better with seller financing. Again, I will ask my team if there's anything we could do on the volume or whatnot. I have no idea. I'm not that guy. But I did want to turn off or unlist that video because all the comments were frankly negative, and I didn't like that, frankly. All right. So again, hopefully that makes sense. I will see if we can clean up the audio. I'm not that guy. I'll ask somebody to do it. We'll see. We do have a presidential debate tonight. Like the last one, I have no interest in watching it, but I will watch or look at the reviews after. But yeah, presidential debate tonight is going to be interesting. What happens? It's interesting. $10 million homes. I don't know if you know this. You've heard me talk about the bifurcation of the market below the median, above the median. It turns out that the super, super elite, the 1% of the 1%, are actually doing really well. Properties sold over $10 million had a record last quarter. New York led that with 72 transactions over 2 million, or over 10 million. That was the largest quarter in the last 2 years. There was a property sold in Palm Beach, private island, for $150 million. Crazy. There were 55 properties in Miami, 42 in LA, 36 in Palm Beach. Sales over $10 million. Must be nice to be uber rich. Yes, crazy amount. Let's talk about Mike Simonson and what's going on with the more traditional homes where you and I play. 704,000 active listings. That's down 2 weeks in a row. 38, but it is up 38% year on year. What is very interesting to me is we're finally talking about withdrawns and expireds. There were 30,000 withdrawn listings. In fact, for every 2 sales, there was 1 withdrawn. Think about that. Again, I think we're going to see withdrawals really grow over the next 90 days. And again, I called it early, and it's proving to be true. Lance Lambert from Resi Club put out a great chart about HELOCs. HELOCs are going up. I did reply saying, and they're only going to go higher. Somebody asked why. Very simple. I think rates are going down. And I think as the HELOC rates go down and get closer to the rates on the first, you will see more and more people tap home equity lines. Whether that is for cushion savings, whether that is to pay down debt, whether that is to go on vacation, I don't know. But the consumer is predictable. And as rates go down, the folks that own assets, the folks that have $18 trillion in tappable equity, they will do what they always do. They will tap it and spend. That is my opinion. Let's talk about Oracle. It was the first earnings of the week that were interesting. They beat top line, beat bottom line. Revenue was actually up 8% year on year. Expect their stock up today. Michael Saylor, the big Bitcoin guy, he's calling for Bitcoin to be 13 million a coin by 2045. 2045. What is that, like 20 years from now? 13 million. I have one. I have one coin. Not sure if I'm going to hold it for 13 million, but hey, it is insurance for me, so we shall see. Brett House, economics professor at Columbia, is saying the vibe session is over. The vibe session is over. He is expecting a soft landing. He's expecting the Fed to start cutting rates. He's expecting the election to be over in November. And as we enter Q1, the recession that has been long called for, including myself, will not materialize, and the soft landing will be achieved. Goldman Sachs actually reduced their odds of a recession from 25 to 20%. And then finally, folks, I want to tell you about an investor in Fresno, California. This investor in Fresno, California has a 7-unit commercial building financed by a local credit union, a very small branch in Fresno. I think it has 2, it might have 3 branches. This particular investor called me in a panic yesterday. Apparently, their credit union sent them a form letter saying that their loan was in default. This particular investor has never missed a payment. In fact, this loan was refied with that bank in the last 9 months. Apparently, the form letter said that their building's DSCR is below 1.25 and the loan is in default. Now, in this particular case, I was able to work with the work with the owner and say, hey, I think this is a problem. I think they have the wrong income, yada, yada, yada. They were able to work through it, and the loan is not in default. However, what does this mean? It means that more and more credit unions, this extend and pretend might be over. If my friend got this form letter, it is no doubt this bank probably sent it out dozens and dozens of times. Also, if this bank did it, or I should say this credit union, how many other credit unions are doing it? In this case, talking to the bank, it sounds like the regulators are getting more focused. They're getting more focused on extend and pretend, and we may be on the cusp of seeing some forced sales in Class B and Class C. Back to how we started this conversation with Ken McElroy, Ben Mala. Again, I think Ken is right. Where he plays in Class A, we might be in the 3rd inning. It may be time for him to start transacting. He's got hundreds of millions to deploy, I'm sure. But for me, little old investor with no pooled capital, no syndications, I don't think Class B and Class C have even started. I think they're still warming up. In fact, they may not even be at the stadium yet. It is pretty early. So again, hope you enjoyed this. I apologize for the poor sound quality on that one video. It's now been unlisted. Thank you for all the support on Iced Coffee Hour. It means the world to me. I read every comment. I tried to reply to every comment. You guys are legends. I got to go because we're talking to Anna Kelly today. We're talking to Coach Carson, Omar, and Beth. Man, what a rock star lineup on Tuesdays. Later.